Mortgage interest rates, the housing market, and today's political scene. What do they have in common? And what might be the result of today's political event that I will intentionally not use the words that YouTube might not like, but obviously there's a big political event happening today in the United States. And how might that outcome from that political event impact the housing market? That's the question that so many people have been asking me. And so I thought I would just take us back to September 18th when the Federal Reserve dropped their Fed funds rate. They dropped interest rates, which is what most Americans and consumers hear. And yet, over the past month and a half, we haven't seen mortgage rates follow suit. We've actually seen mortgage rates move the opposite direction. So let's dig into that a little bit today and see if we can pull any potential outcomes from today's political event and how that might impact the housing market going forward. I'm going to share my screen here and jump into a few slides because I think this will really help to set the stage. So as I mentioned back on September 18th, Federal Reserve cuts interest rates by 0.5%. Hurrah! The housing market's going to get affordable again, right? Well, not so much. We see that just 45 days-ish later, as of yesterday, November 4th, mortgage rates inch up nearing a 4-month high. So why is that? Well, the first thing that you should understand as a potential home buyer or someone interested in the housing market is that the Federal Reserve doesn't control mortgage rates. The Federal Reserve controls the federal funds rate. Well, what's the Fed funds rate? The Fed funds rate is quite literally a 24-hour overnight lending rate from one bank to another bank. It is the rate of interest that a bank can borrow from another bank in case they have an overnight liquidity shortage. It is a 24-hour lending rate. And so it makes sense, once we understand what the Fed funds rate is, that it wouldn't have a direct correlation. It wouldn't move a 30-year fixed mortgage interest rate because the Fed funds rate is only set for 24 hours. Now, it is true that the Fed adjusts that rate when they have their Fed meetings, but there's slight oscillations night to night on that bank lending rate within the range that the Fed sets. So what then controls mortgage interest rates if it's not the Fed funds rate? Well, let's talk about what's going on with the US deficit, because what controls or what drives mortgage interest rates is the future expectation of inflation and the future expectation of economic growth in the United States. And we have the US government, the Treasury to be specific, doing something lately that is considered to be potentially highly inflationary. And that is they are borrowing record amounts of money. So on October 18th, the end of the fiscal year for the US government, for the Treasury, is the end of September 2024, and the beginning of the fiscal year would have started in October 2023. So at the end of September, the fiscal year is over, and it's reported that the US budget deficit tops 1.8 trillion in fiscal year 2024, the third largest on record. But here's what's crazy. We're not in the middle of a pandemic. We're supposed to be in a strong and robust economy. So why is it, if we're in a strong and robust economy, is the US government borrowing $1.8 trillion to fund their spending? Well, that fact is what's leading to these higher mortgage interest rates, because this massive spending by the US government, they have massive spending, and so they need to do near record borrowing to cover that spending. And that is presumed to be highly inflationary by the bond market. And that's what sets mortgage interest rates. So let's dig into this just a little bit more. Let's take a look at this on a graph going back to October 2023, which would have been the beginning of the fiscal year that went through September 30th, 2024. And you can see over here, this would be $33.5 trillion in debt. And you can see that debt steadily moving up throughout that year. And now, in the very end of the year, right at the end, right about when the Fed cuts the Fed funds rate, the Treasury takes on this tremendous amount of additional debt. And that spike in U.S. debt is what was interpreted by the bond market to be highly inflationary, and why they've reacted the opposite. The mortgage rates have reacted the opposite direction than the Fed funds rate. Let's zoom out a little bit and let's look at this over a little bit longer period of time. So if we go a little bit longer, yeah, you're right. We're just going to go back another 220 years. So if we go back to 1800, this is the total outstanding debt in trillions of dollars going back over that 220-year period of time. And here's what's really interesting. It took, well, it'd be 224 years of time to be specific, but who's counting? It took 220 years for the U.S. debt to reach 11 trillion, right? So that would be from approximately 1800 all the way over here until about 2020. $11 trillion in debt. But this is what is so incredibly staggering. For the U.S. debt to add an additional 11 trillion, it did that it only took 4 years from 2020 here to 2024. And today, our outstanding total debt is near 35 trillion. So the point is, the rate at which we are adding debt is insane. And that is considered very, very, very highly inflationary. Now, here's the thing that you need to understand. Mortgage rates follow the future expectation of inflation. So if the government is spending and borrowing like drunken sailors, that is expected to bring on inflation in the economy. And as there's higher inflation rates, those investors that buy mortgage-backed securities, they're the ones who actually invest in those mortgages that we're borrowing to secure home financing. They want a higher interest rate because they believe that the inflation is going to erode the value of the dollar. I would say they know that inflation will erode the value of the dollar. So that's why we can see the Fed back here on September 18th cuts mortgage rates. Cuts the Fed funds rate, Mortgage rates at that time were around 6%. And if we fast forward today, we're approaching 7%. So how does this all play into the political events? Well, until we see some sort of movement back to fiscal responsibility in the United States, until we quit spending and borrowing as a government like drunken sailors, we're likely to see higher and higher mortgage rates. So regardless of the outcomes of today's political event, the reality is until we get back to fiscal responsibility, we will likely see bouts of higher interest rates, perhaps followed by a crash, which I believe we will see an economic slowdown here in the next year, a recession. I think that we may see interest rates come down through that period of time. But if we go back to what we've done in the past, which is reckless spending through those recessions, that could light off the next leg of the inflationary market. Hey, I hope this was valuable to you. I would encourage you to follow our channel, comment, and